In this video, I'm going to talk about two items that I haven't talked about before having to do with cash flow. The first is that when you have a sale of the assets, when you're using MACRS depreciation, you need to remember the half-year convention, and I'll show you how to handle that in a cash flow example. The second thing is working capital and how to handle working capital in the cash flow example. So the way I'm going to do it is I'm going to go through this in an example and talk to you about how it is, and I'm actually going to show you in an Excel spreadsheet again. So we have this example where the initial investment is $4,000. It's depreciable using a 5-year recovery period, but it's only going to be a 3-year life. You can see down here we have at the end of the 3rd year we're going to sell the asset, and it requires an $8,000 investment in working capital. So working capital is an investment necessary to conduct business. This is things like if you have a retail establishment, you might need to buy inventory in order to set up the retail. But that portion, which is called working capital, is not depreciable. It also is liquidated at the end of the project. So we have this initial cost, but then the same exact liquidation at the end of the project. So we're going to use that. We're going to go through an example of that. I'll show you how to use that in this example. Sales volume is 3,000 units. Sales price is 75 cents a unit. Cost of goods is 10 cents a unit. Operating cost is $500. Tax rate 40%. 3-year life, and we have the sale at the end of the 3 years. I'm going to go ahead and show you how to do this in an Excel spreadsheet. So we're going to start off by an initial investment here of $4,000 is what it said in there. And then we're going to need to liquidate it at the end, but we need to calculate depreciation. So we're going to go ahead and calculate depreciation, which is equal to this times 0.2. So it's a 5-year recovery period. So if you look on your handout, you can find for a 5-year recovery period, the first depreciation is 20%. I'm putting a minus number on there because I want cash flow depreciation to end up positive, just because that's the convention we use. In the next year, it's 32%. And in the next year, it is 19.2%. But the thing is, with half-year convention in MACRS, the assumption the IRS makes is that you're selling this not at the end of the 3rd year, but at the half-year place, which is July 1st. So you can only take half a year of depreciation for this asset. So you have to divide it in 2. So that's going to be the depreciation schedule. I'm going to go ahead and put these values up here. Just copy them over because we want that to be all the same. The other thing we have is this, what is it, an $800 investment in working capital, which is going to be liquidated at the end of the time period. So we have a negative investment here and a positive liquidation of that inventory there. This now is not depreciable like the capital investment amount, but it is included as a negative outflow. So now we're ready to do the calculations of the revenue. So it's 3,000 times 75 cents a unit, 3,000 times 10 cents a unit, and then we also have a $500 a year operating expense. So we take this one minus that. It's going to copy all of that over because it's the same in every year. This too, I should have copied that. This number is the gross margin minus operating expense minus that. So the taxable income is $650 in the 1st year. Then we're going to take 40% of this. And net income is the taxable income minus the taxes. Whoops. I'm going to drag that over. And the cash flow is the net income plus depreciation. Now I have all the cash flows, plus I have this initial investment and this liquidation. The thing I don't have here is the gain on the sale. So I'm going to go up here and do that calculation separately. The book value is going to be the initial investment of $4,000 minus all the depreciation to date. So I'm just going to go ahead and subtract out these depreciation numbers to get the book value. The gain is equal to the $500 that I'm selling it for minus the book value, which is actually a loss. But we're going to go ahead and make that calculation anyway, take 40% of it for taxes, and the cash flow is going to be, the $500 minus a minus tax, so it's a positive $900. So we have a positive cash flow. This is the salvage value from that $500 pre-tax value. So now I'm going to just calculate cash flow. So it's $4,800 negative cash flow, and a couple years a positive, and then this one includes the liquidation of the assets. So now I'm going to go ahead and calculate this back to time period 0, which is that value. And I'm just going to add all these up. And that means that we had a negative, the net present value of this project is negative 339, which is less than 0, so it's not a good investment. Now, what I showed you on this is the depreciation using this half-year convention. So I divided that by 2 when we use MACRS depreciation. And I also included you here this looking at working capital, how to take the negative investment and then the liquidation of that at the end. So I hope you understood the 2 concepts we talked about in this video, the sale of assets from using MACRS half-year convention and working capital.